If you've seen the viral story, you've heard that a young AI genius built a $45 billion fund, lost $24 billion in days, and got liquidated by Wall Street. Almost every number in that sentence is unverified. What actually happened is more interesting. Situational awareness didn't publicly enter legal liquidation, but after a brutal reversal in crowded AI trades, the fund couldn't control its financing and sold most of its public stock book to Citadel in a deal assembled in roughly 24 hours. Its private investments survived. Its SEC registration was still active. The public casino table, however, had been cleared. That's the first distinction you need to keep in mind. So, was this a setup? Or did a brilliant long-term thesis collide with a short-term margin call? To answer that, we'll follow the money from 165-page prediction to one very narrow exit door. Leopold Aschenbrenner didn't arrive through the usual Wall Street pipeline. He grew up in Berlin, entered Columbia at 15, and graduated as valedictorian at 19, studying economics and mathematics statistics. Before most people his age had finished college, he'd also spent time around Oxford researchers studying long-run economic growth and existential risk. Then came two institutions that would define his public image. First, he worked at the FTX Future Fund. By his own later account, a team of roughly 4 people worked punishing hours while trying to deploy billions of dollars. FTX then collapsed in fraud. There's no public evidence that Aschenbrenner was involved in that fraud, but he'd watched a tiny team move enormous capital inside an institution whose foundations were weaker than they looked. Next, he joined OpenAI's Superalignment Group, the team associated with Jan Leake and Ilya Sutskever that studied how to control systems smarter than humans. In April 2024, OpenAI fired him over alleged leaking. Aschenbrenner disputed that description. He said he'd shared a safety preparedness draft with 3 outside researchers and argued that his dismissal followed a warning to the board. OpenAI denied that the safety memo caused his firing and disputed parts of his account, so this wasn't a clean whistleblower story, and it wasn't proof that OpenAI was silencing a prophet. It was a public rupture that gave a very young researcher an outsider identity. If you didn't know him before this fund crisis, that's the public character he brought into it. 2 months later, Aschenbrenner published Situational Awareness, The Decade Ahead, roughly 50,000 words across 165 pages. It wasn't a new AI model or a peer-reviewed breakthrough. It was a strategic forecast assembled from public evidence, technical extrapolation, economic history, and what he openly called San Francisco gossip. Its central claim was explosive. AI progress could accelerate toward extremely capable systems around 2027, forcing a historic build-out of chips, power, data centers, memory, networking, and national security. The essay and a marathon podcast appearance spread through Silicon Valley. Supporters began treating him as an AI oracle. Critics saw a brilliant but dangerously confident extrapolator. You don't have to accept his forecast to understand why investors found the map compelling. That forecast wasn't a fact. It was a map. And Aschenbrenner turned the map into a fund. Situational Awareness reportedly launched with about $225 million from technology insiders, including Patrick and John Collison, Nat Friedman, and Daniel Gross. It wasn't ordinary seed capital. It was Silicon Valley betting that the outsiders' map was early. Aschenbrenner was the managing partner and public face. Carl Schulman, a longtime AI forecaster with earlier hedge fund experience at Peter Thiel's Clarium Capital, became research director and co-portfolio manager. The latest public filing listed only 8 employees. That's a very small team steering a very large machine. Their edge wasn't simply buy NVIDIA. Their question was, if the AI forecast is right, what runs out first? Once you ask it that way, the portfolio makes more sense. Power, land with grid access, converted mining sites, memory, storage, optical networking, cloud capacity, and, privately, the model companies themselves. That bottleneck map produced spectacular winners. Applied Digital signed long leases with CoreWeave for AI data center capacity. Bloom Energy sold the idea of delivering on-site power at the speed of AI. SanDisk reported surging data center demand. IRN and other former crypto infrastructure names were revalued as AI cloud and power assets. The biggest prize may have been private. Anthropic announced a $61.5 billion valuation in March 2025. By May 2026, it announced a valuation of $965 billion. Reporting says Situational invested early, and that Anthropic grew to roughly 1/5 of the fund. That doesn't mean the fund earned the full 15-fold valuation increase, but it explains the rocket fuel. By June, the Wall Street Journal reported more than $20 billion under management, about 270% after fees for 2026 through May, and more than 1,000% since launch. Those figures weren't published in an audited return sheet, but the direction's clear. The thesis worked, capital rushed in, and the small fund became a giant. Then the balance sheet started leaving clues. At the end of 2024, the fund's Form 13F listed about $255 million. 15 months later, the headline table value was $13.7 billion. You can see why social media treated that as proof of explosive asset growth. But here's where many viral accounts go wrong. The Q1 2026 filing included about $9.8 billion of option underlier value. Only about $3.9 billion was non-option common stock value. A 13F doesn't show option premiums, strikes, expirations, shorts, swaps, cash, private assets, or real-time leverage. It isn't AUM, and it isn't a net risk report. What you can see is exposure. What you can't see is the complete balance sheet. Still, it revealed concentration. Bloom Energy, SanDisk, CoreWeave, Iron, and Core Scientific made up roughly 76% of the disclosed common stock book. The same filing showed large puts on semiconductor and AI names. Those could have been hedges or bearish bets. The form can't tell us which. The fund wasn't just making one AI bet. It was balancing an intricate set of longs, shorts, and options around one dominant macro story. Intricate books can look diversified on paper while sharing one exit door. By late June, that door was already getting crowded. Chip stocks reversed. Hedge funds sold technology hardware for several consecutive weeks. Korean memory names were later hit by financing worries and competitive pressure. This matters because the sell-off began before the event that later fueled conspiracy theories. If you're judging the setup claim, you can't skip that chronology. On July 7th, the Bank of England issued an extraordinary warning. Global hedge fund equity prime brokerage balances had risen around 40% in a year. Positions had become concentrated in sectors such as semiconductors. Leveraged positions, it said, could be forced to unwind quickly and amplify volatility. It wasn't naming situational awareness, it was describing the trap before this fund fell into it. 17 days later, according to the Financial Times, Situational told investors it hadn't been immune, especially in Asia. But the fund also called the sell-off one of the best opportunities since early 2025 and invited new commitments by August 1st. That's the tragic turn. 6 days before selling the public book, the fund still wanted more chips for the table, then prices fell again. Here's the mechanism. You don't need a conspiracy for it to become violent. The assets fall. Prime brokers recalculate risk and demand more collateral. The fund can post cash, sell positions, or reduce exposure. But when many positions are connected to the same AI trade, the things meant to diversify the book can't always protect it together. Now the fund needs cash precisely when everyone knows it needs cash. Potential buyers won't offer the price they'd pay in calm markets. They'll demand a discount for volatility, complexity, and the risk of unloading the positions later. Selling pushes prices lower, which can create more margin pressure. Loss, margin call. Forced sale, lower price. Another margin call. Leverage didn't necessarily make the AI thesis false, it shortened the thesis's deadline. On July 29th, reporting said Situational was urgently seeking capital, speaking with investors and lenders, and offering pieces of the portfolio. By July 30th, Citadel had agreed to buy most of an approximately $16 billion public equity book. The transaction was assembled in roughly 24 hours. Millennium also reportedly bid. That's not how you choose to exit, it's how you exit when time's no longer yours. This was not a normal rebalance, it was the sale of the exit door. Now for the uncomfortable question, days before the deal, Citadel Securities published a contrarian view that the Federal Reserve might raise rates. Then markets fell, then Citadel, a separate but affiliated investment firm, bought the distressed portfolio. Reuters also reported that Aschenbrenner blamed short sellers for worsening the damage. If you're looking for the conspiracy theory's strongest image, that's it. That sequence looks suspicious. It isn't proof. First, the AI sell-off had been running for weeks. Second, interest rate markets already assigned a meaningful chance to a hike. The Fed ultimately held rates, but 3 voters wanted an immediate increase. Third, the contractual pressure came from prime brokers, not from Citadel. Fourth, Other firms bid for the assets. None of that proves the auction was perfectly fair. It does mean you'd need stronger evidence to call it engineered. And most important, there's no public order trail, margin notice, transaction price, internal message, court case, or regulator allegation showing that Citadel, short sellers, or the prime brokers coordinated to manufacture the crisis. Could traders have smelled a forced seller and pressed the weak positions? Absolutely. Markets do that. A visible, concentrated portfolio under financing pressure can be front-run without a secret conspiracy. If you show Wall Street that your exit has a deadline, somebody will trade against the clock. Citadel may have exploited the bargaining power of a distressed buyer, but profiting from the wreckage isn't the same as causing the crash. The evidence shows predation after the prey was exposed. It doesn't show who fired the first shot. This is also why the word liquidated needs care. You can liquidate a trading book without legally liquidating the whole fund. Axios reported that all public equities were sold. The Wall Street Journal said the bulk, Reuters said most. The safest conclusion is that nearly the entire public equity book was transferred. But private holdings, including Anthropic, remained. Reporting said the firm could continue as a private investment operation. Its SEC advisor status was still active on August 1st. We don't have an audited loss, the final net asset value, the block sale price, or proof that investors were wiped out. So when you hear gone in a week, you're hearing a conclusion the public record can't support. This isn't the same as Archegos, which hid massive swap exposure and later faced fraud and manipulation charges. The margin call mechanics rhyme. The legal evidence doesn't. Leopold Aschenbrenner may still be right that AI will transform the economy. His fund may even retain enormous value in Anthropic and other private assets. That's why this story isn't finished. But investing isn't only about being right on the destination. It's about surviving the path. Situational awareness used a long horizon forecast to build one of the fastest growing funds on Wall Street. Concentration and leverage accelerated the climb. They also placed the clock in someone else's hands. The real liquidation wasn't necessarily the fund. It was the fund's right to wait. And on Wall Street, whoever controls your deadline controls your exit.